Good morning. Let's talk about something happening right now in the precious metals market that deserves your careful attention. BlackRock, the world's largest asset manager with over $10 trillion under management, has been making significant moves in the silver mining sector. At the same time, technical analysts and market observers are pointing to patterns that historically precede major price movements in silver. This isn't about chasing headlines. This is about understanding what institutional capital is doing while retail investors are still trying to figure out the game. Here's what matters. When the largest financial institutions in the world shift their positions, they're not reacting to news you're reading today. They're positioning for conditions they expect 6 months, 12 months, or 2 years from now. The silver market is relatively small compared to gold or equity markets. This means institutional involvement can move prices dramatically. And right now, we're seeing a convergence of factors that hasn't occurred in over a decade. You need to understand what's happening. More importantly, you need to understand what it means for your portfolio, your strategy, and your financial future. This conversation isn't about getting rich quick. It's about recognizing structural shifts in commodities markets and responding with intelligence and discipline. Let's begin with the facts. BlackRock's involvement in silver miners represents something more significant than a simple investment thesis. It represents a calculated bet on industrial demand, monetary instability, and commodity scarcity. Understanding institutional behavior requires looking beyond individual trades. Large asset managers don't make billion-dollar decisions on speculation alone. They conduct extensive research. They model supply chains. They analyze geopolitical risk. They forecast industrial trends years into the future. When institutions increase exposure to silver mining companies, they're not just buying silver. They're buying leveraged exposure to the underlying commodity. A mining company's stock price can move 3 to 5 times more than the metal itself during bull markets. This is critical to understand. If silver moves from $30 to $40 per ounce, a well-managed mining operation might see its profit margins double or triple. The stock price responds accordingly. BlackRock knows this. Every institutional player knows this. The question is, do you understand the leverage dynamics at play here? The silver mining sector has been largely ignored by mainstream investors for years. After the 2011 peak, when silver briefly touched $50 per ounce, the sector entered a brutal bear market that lasted nearly a decade. Companies went bankrupt, projects were abandoned, exploration budgets dried up, the entire sector contracted violently. This created something important, a supply deficit that's emerging now, more than a decade later. Mines don't appear overnight. New silver deposits take 7 to 10 years to bring into production, from discovery to first pour. The supply shortage developing today is the direct consequence of underinvestment from 2013 to 2020. Meanwhile, demand has been growing steadily, driven by solar panel production, electronics manufacturing, and electric vehicle components. Silver is the most conductive metal on Earth. It's irreplaceable in certain industrial applications. As the world electrifies, silver demand isn't discretionary. It's structural. This is what BlackRock sees. This is what sophisticated capital understands. Let's discuss market cycles with clarity and precision. Every commodity moves through distinct phases: accumulation, markup, distribution, and markdown. Right now, based on technical patterns, on-chain data, and industrial demand trends, silver appears to be transitioning from accumulation into the early stages of markup. What does this mean in practical terms? It means the patient capital that bought between $18 and $24 per ounce is beginning to see validation. It means momentum is shifting. It means new participants are entering the market. But here's where most investors make their first critical mistake. They confuse the early stage of a cycle with the late stage. They see prices rising and assume they've missed the opportunity. History tells us something different. In commodity bull markets, the majority of gains occur in the final third of the cycle. The first phase is slow. The middle phase is steady. The final phase is parabolic. We saw this in 2010 and 2011. We saw this in the 1970s. We've seen this pattern repeat across gold, oil, copper, and agricultural commodities for over a century. If we're genuinely in the early markup phase, then the largest moves haven't happened yet. But this requires patience. It requires conviction. It requires the emotional discipline to hold positions while others panic during inevitable corrections. And let's talk about the number being discussed: $94 per ounce. Where does this figure come from? Technical analysts use various methodologies. Some examine historical resistance levels. Others use Fibonacci extensions. Some calculate potential targets based on inflation-adjusted previous highs. Silver's all-time nominal high was approximately $50 in 2011. Adjusted for inflation, that's roughly $70 to $75 in today's currency. A move to $94 would represent a new inflation-adjusted all-time high. It would require a fundamental repricing of silver based on industrial scarcity, monetary debasement, or both. Is this guaranteed? Absolutely not. Markets don't move in straight lines, and projections are not promises. But is it possible within a major commodity cycle? History suggests it is entirely plausible, assuming certain conditions materialize. Now we need to address the broader macroeconomic environment, because silver doesn't exist in a vacuum. Central banks worldwide have expanded their balance sheets dramatically over the past 15 years. The money supply has grown at rates previously considered impossible. Debt to GDP ratios in developed economies have reached peacetime records. When you increase the supply of currency faster than you increase the supply of goods and services, you create inflation. Not the transitory kind that policymakers hope for, the structural kind that erodes purchasing power systematically. Precious metals historically serve as a store of value during periods of monetary instability. Gold gets most of the attention, but silver has industrial utility that gold lacks. This creates a unique dynamic. Silver benefits from both monetary concerns and industrial demand. It's both a precious metal and an industrial commodity. During the 1970s inflation crisis, silver outperformed gold on a percentage basis. It's more volatile, more leveraged to economic activity, and historically more explosive during commodity supercycles. We're also seeing geopolitical fragmentation that hasn't existed since the Cold War. Supply chains are being restructured, nations are stockpiling strategic materials. The globalized just-in-time system is being replaced with just-in-case redundancy. Silver is a strategic material. It's critical for defense applications, for green energy infrastructure, for telecommunications. Countries don't want to depend on foreign supply for critical resources. This drives stockpiling behavior. This drives domestic mining incentives. This tightens available supply for commercial markets. Add the electrification trend, and you have multiple demand drivers converging simultaneously. Solar installations alone are projected to consume record amounts of silver annually for the next decade. Meanwhile, recycling rates for silver remain relatively low compared to gold. Much of the silver used in industrial applications is consumed and dispersed in ways that make recovery economically unfeasible. This is a deficit market masquerading as a surplus. The visible inventories are declining. The exchange warehouses are being drawn down. The physical market is tightening while the paper market still trades with massive leverage. Institutional players understand this disconnect. They're positioning accordingly. Let's discuss something crucial: how most investors actually behave versus how they should behave. The average investor buys near tops and sells near bottoms. This isn't a moral failing, it's human psychology. We're wired to feel comfortable buying when everyone else is buying, and to panic when prices fall. This is exactly backward. Wealth is built by buying what's unloved and selling what's beloved. Right now, silver miners remain relatively ignored by mainstream finance. They're not featured on the cover of financial magazines. They're not trending on social media. Retail investors aren't discussing them at dinner parties. This is actually encouraging. It suggests we're not in the euphoric late stage of a bubble. It suggests there's still substantial room for new capital to enter the sector. When you hear your taxi driver discussing silver stocks, when mainstream media is breathlessly covering the silver surge, when retail investors are leveraging themselves to buy call options on mining companies, that's when you start looking for the exit. We're nowhere near that stage yet. But timing matters, and timing is impossibly difficult. No one can predict exact bottoms or tops. The professionals don't even try. Instead, sophisticated investors focus on accumulating positions during periods of indifference and reducing positions during periods of euphoria. They build positions gradually. They scale in over time. They average their cost basis across multiple entry points. This approach isn't exciting. It doesn't generate impressive stories at parties, but it works consistently over decades. Here's what doesn't work: waiting for perfect certainty before acting, waiting for confirmation, waiting until the trend is obvious to everyone. By the time an investment thesis is obvious, most of the gains have already occurred. You're paying a premium for consensus. The uncomfortable truth is this: the best buying opportunities feel terrible. They feel risky. They feel uncertain. Your brain screams at you to wait, to gather more information, to see what happens next. By the time you feel comfortable, you're buying from the people who were uncomfortable 2 years ago. You're transferring your wealth to them. If you already hold positions in silver or silver mining companies, listen carefully. This section is specifically for you. First principle: don't let unrealized gains evaporate due to complacency. This is the most common mistake among investors who correctly identified a trend early. You did the hard part. You bought when others were skeptical. You endured the sideways consolidation. You maintained conviction when the position sat in the red for months or years. Now the thesis is beginning to play out. Prices are moving. Your account balance is growing. This is where discipline becomes critical. Establish clear protocols before emotions take over. Decide now, while you're thinking clearly, at what levels you'll take partial profits. Not to exit completely, but to secure gains systematically. A proven approach: take 20% off the table when your position doubles. Take another 20% when it triples. Let the remaining core position ride for as long as the trend remains intact. This ensures you capture real profits while maintaining exposure to further upside. It removes the binary pressure of trying to time the perfect exit. Second principle, understand the difference between conviction and stubbornness. Conviction means holding through normal volatility because your thesis remains intact. Stubbornness means ignoring evidence that your thesis was wrong. How do you tell the difference? You need clear invalidation criteria. What would need to happen for you to conclude you were wrong about this trade? Is it a breakdown below certain technical levels? Is it fundamental deterioration in mining company balance sheets? Is it changes in industrial demand trends? Define this now. Write it down. When emotions run high, you'll have an objective framework to reference. Third principle, prepare psychologically for volatility. If silver is truly entering a bull market, you will experience drawdowns of 20 to 30% along the way. These aren't failures of your thesis, they're normal corrections within trends. The 2010-2011 silver rally included multiple corrections, exceeding 25% before ultimately reaching $50. If you sell during these corrections, you'll likely re-enter at higher prices or miss the resumption of the trend entirely. This is how investors transform winning positions into mediocre returns. You must develop the emotional capacity to withstand violent volatility without abandoning your position. This is not optional. This is the price of participation in commodity markets. Fourth principle, consider tax implications and position sizing. If you're holding in a taxable account, understand the difference between short-term and long-term capital gains. Holding beyond 12 months can cut your tax liability substantially. This might influence whether you take profits at certain levels or hold for preferential treatment. Also, ensure your position size allows you to sleep at night. If your silver exposure is causing anxiety, it's too large. You cannot maintain discipline if you're emotionally overwrought. As a general guideline, commodity positions should represent a minority of your total portfolio unless you have exceptional risk tolerance and deep expertise. 10 to 20% in precious metals and miners is reasonable for most investors. More aggressive allocations should be reserved for those with genuine conviction and the psychological fortitude to handle extreme volatility. If you're considering entering positions in silver or silver miners, this guidance is for you. First question, are you buying a thesis or chasing a price? Be brutally honest with yourself. If you're buying because you understand the supply-demand fundamentals, the monetary backdrop, and the industrial demand trajectory, you're buying a thesis. If you're buying because you saw prices rising and don't want to miss out, you're chasing. Chasing rarely ends well. It leads to panic selling during normal corrections. It leads to bad entries and poor risk management. If you're buying a thesis, then temporary price weakness is opportunity, not crisis. If you're chasing, temporary price weakness triggers fear and capitulation. Which mindset describes you right now? This matters more than you realize. Second consideration, how do you gain exposure? You have several options, each with different risk-reward profiles. Physical silver provides direct exposure without counterparty risk. You own the actual metal. But storage is a concern, liquidity is limited, and premiums can be high. Silver ETFs provide easy exposure with good liquidity, but introduce counterparty risk and management fees. You don't own physical metal. You own shares of a trust that owns metal. Silver mining stocks provide leveraged exposure to the metal price. A well-managed miner can deliver multiples of silver's percentage gain, but they also carry operational risks, management execution risk, and can decline even when silver rises. Junior mining companies offer the highest potential returns, but also the highest risk. Many will fail. A few will deliver extraordinary gains. This is venture capital territory disguised as public markets. Your choice depends on risk tolerance, time horizon, and expertise level. Conservative investors should emphasize physical metal or established ETFs. Aggressive investors comfortable with volatility can allocate to quality mining companies. Third consideration, entry strategy. Don't deploy all capital at once unless you have exceptional conviction and experience. Instead, build positions gradually over weeks or months. This averages your cost basis and reduces the risk of buying at a temporary local top. Consider scaling in at predetermined price levels. For example, buy 25% of your intended position now, another 25%, if prices correct 10%, another 25%, if they correct 20%, and hold the final 25% in reserve. This approach ensures you get exposure while protecting against poor timing. You'll never buy the exact bottom, but you'll build a reasonable average entry. Fourth consideration, risk management. Before entering any position, determine your stop loss level. Where will you exit if you're wrong? At what price does the thesis break down? Define this before you buy and honor it if triggered. Many investors skip this step because it feels pessimistic or because they plan to just hold forever. This is how small losses become catastrophic ones. Professional traders never enter a position without knowing their exit. Neither should you. Finally, understand your time horizon. Commodity cycles unfold over years, not weeks. If you need this capital in 6 months, you shouldn't be deploying it in silver miners. Only invest capital you can afford to leave untouched for 3 to 5 years. Anything shorter, and you'll be forced to sell at inopportune times due to liquidity needs. Not all silver miners are created equal. Understanding how to evaluate these companies separates successful investors from those who buy blindly and hope. Start with the fundamentals. What's the all-in sustaining cost of production? This metric tells you what it costs the company to produce each ounce of silver, including exploration, development, and administrative expenses. If a company's all-in sustaining cost is $20 per ounce, they're profitable at current prices. If it's $35, they're struggling or losing money. Profit margins expand dramatically as silver prices rise. A company producing at $20 per ounce sees its margin grow from $10 per ounce to $74 per ounce if silver reaches $94. That's not a linear increase. That's exponential leverage to the underlying commodity price. Second metric, reserve life. How many years of proven and probable reserves does the company have? A mine with 25 years of reserves is fundamentally different from one with 5 years remaining. Longer reserve life means longer production runway, less near-term exploration risk, and more stable valuation. Third metric, jurisdiction. Where are the mines located? Political stability matters enormously in mining. A mine in Canada faces different risks than a mine in an unstable developing nation. Expropriation risk, regulatory changes, and taxation policies can destroy shareholder value overnight in certain jurisdictions. Geographic diversification across multiple stable jurisdictions reduces this risk. Fourth metric, management track record. Has leadership successfully developed mines before? Have they delivered shareholder value historically? Or do they have a pattern of dilution and value destruction? Review past capital allocation decisions. Review how they managed previous commodity cycles. Management quality in mining is everything. Fifth metric, balance sheet strength. Does the company have manageable debt? Can it weather a temporary price decline without bankruptcy risk? Companies with fortress balance sheets survive downturns and emerge stronger. Over-leveraged companies often get wiped out during normal commodity corrections. During the next silver bull market, dozens of mining stocks will rise. But the best managed companies with the lowest costs and strongest balance sheets will dramatically outperform. Do your homework. Read financial statements. Compare metrics across multiple companies. Understand what you're buying before you deploy capital. Now we address the mistakes that destroy capital in commodity markets. Pay close attention. These warnings come from observing thousands of investors over multiple cycles. Buying on euphoria and selling on panic is the fastest way to transfer wealth from your account to disciplined investors. You must develop emotional detachment from short-term price movements. If seeing your position down 20% triggers panic selling, you're not psychologically prepared for commodity investing. Either reduce position size or avoid the sector entirely. Using margin, selling options you don't understand, or concentrating excessive portfolio percentage in a single sector magnifies both gains and losses. During corrections, leverage forces you to sell at the worst possible time. It transforms temporary drawdowns into permanent loss of capital. Never leverage commodities unless you're a professional trader with extensive risk management experience. The majority of leveraged retail traders lose money consistently. Trading frequently in taxable accounts generates short-term capital gains taxed at ordinary income rates. This can consume 30 to 40% of your profits. Strategic holding periods and tax loss harvesting can save thousands or tens of thousands in taxes over time. Consult with a tax professional about optimal structuring. Junior mining companies are speculative by nature. Most will fail. A few will succeed dramatically. But retail investors often buy junior miners based on promotional materials, online hype, or stock message boards. This is gambling, not investing. If you allocate to juniors, limit it to 5 to 10% of your metals exposure, and only buy after thorough due diligence on management, geology, and financing. Putting everything into 1 or 2 mining stocks creates concentration risk. A single operational failure, regulatory problem, or management misstep can destroy decades of wealth. If you're investing in miners, own at least 5 to 10 quality companies across different geographies and stages of development. Many investors ride positions up beautifully, then ride them all the way back down. They confuse temporary unrealized gains with permanent wealth. Establish a systematic profit-taking protocol before emotions take over. Capturing real profits during bull markets funds your next opportunities during bear markets. Silver and miners should be part of a diversified strategy, not your entire net worth. Maintain exposure to uncorrelated assets. If precious metals represent more than 30% of your liquid net worth, you're likely overconcentrated, unless you have exceptional expertise and risk tolerance. Social media, forums, and chat rooms are filled with speculation, manipulation, and genuinely terrible advice. People promoting positions often have agendas you don't understand. Do your own research. Read primary sources. Understand financial statements. Make decisions based on data, not hype. Waiting for the absolute bottom before buying means you'll likely never buy. Perfect timing is impossible, even for professionals. Better to establish positions gradually at reasonable valuations than to wait indefinitely for perfect conditions that never materialize. Your strategy must survive contact with real market conditions. If your rules say hold, but fear says sell, discipline must win. Write down your rules when you're calm and rational. Follow them when you're emotional and uncertain. This is the only reliable path to long-term success. Let's synthesize what we've covered into actionable understanding. The silver market is experiencing institutional attention that hasn't existed in over a decade. BlackRock's positioning in miners represents sophisticated capital-making calculated bets on future supply constraints and demand growth. Technical patterns suggest the potential for significant price appreciation. Whether that reaches $94 or something higher or lower is unknown, but the setup resembles previous commodity cycles that delivered substantial returns. The opportunity exists for those with patience, discipline, and proper risk management. The danger exists for those who chase prices emotionally, overlever, or abandon their strategy during inevitable volatility. Your success in this environment won't be determined by your ability to predict exact prices. It will be determined by your emotional discipline, your systematic approach to position building, and your capacity to endure discomfort. If you're currently holding positions, maintain conviction while implementing profit-taking protocols. Prepare psychologically for volatility. Honor your predetermined exit criteria if the thesis breaks down. If you're considering entry, build positions gradually, manage risk systematically, and invest only capital you can afford to leave untouched for years. Understand that commodity cycles are among the most psychologically challenging investment environments. They test your patience during long periods of consolidation. They test your discipline during explosive rallies. They test your conviction during brutal corrections. Most investors fail these tests. They buy too late, sell too early, over-leverage, or abandon their strategy at exactly the wrong time. You can be different. You can approach this opportunity with professionalism, with clear thinking, with proper risk management. The institutions are positioning, the fundamentals are developing, the technical patterns are forming. What happens next depends on how you execute. Not on luck, not on hoping. On execution. Maintain your discipline, honor your rules, manage your risk, take profits systematically. Stay informed but not obsessed. Wealth in markets is built by doing the boring things consistently over long periods. It's built by being patient when others are impulsive, by being greedy when others are fearful, and by being cautious when others are euphoric. This is your opportunity to apply those principles. This is your opportunity to demonstrate that you can think clearly when others are reacting emotionally. The next 12 to 24 months will be revealing. Some investors will emerge with substantial gains and valuable lessons. Others will emerge with losses and regrets. The difference won't be intelligence. It won't be access to information. It will be discipline. You have the information now. You understand the setup. You know the risks and the opportunities. What you do with this understanding is entirely up to you. Approach this with seriousness. Approach it with humility. Approach it with the recognition that markets reward patience and punish impatience. Build your positions thoughtfully. Manage your risk carefully. Execute your plan systematically. And remember, the goal isn't to get rich quick. The goal is to build wealth steadily, protect what you've built carefully, and compound your success over decades. This is how financial independence is actually achieved. This is how generational wealth is actually created. Not through speculation, not through gambling, through systematic execution of sound principles over sufficient time. You're capable of this. You have the information. You have the framework. Now you need the discipline to execute. The opportunity is developing. The institutions are positioning. The fundamentals are aligning. Your response to this moment will define your results for years to come. Choose wisdom over impulse. Choose patience over panic. Choose discipline over emotion. This is how you succeed in markets. This is how you build lasting wealth. The rest is execution. Thank you for your attention. Now it's time to act with intelligence and discipline.